We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back. Trevor's falling out of his chair.
Wow.
This is Deal Junkies back in the studio with Michael Hamilton. Thanks again for joining us, Michael.
Yeah.
We're all here. We want to do a deep deal dive. We want to dig into your brain a little bit. Trevor's going to take over, and he's going to ask you a bunch of crazy questions.
Oh, great.
Are you ready for this? This is like, did you study for your quiz
take
today?
off my quarter zip. It's going to get hot in here.
Yeah, let's break down one of your most recent deals or more recent deals that you're doing and like how you got into it and the life cycle of the deal.
Yeah. I would say my favorite deal right now is our largest deal to date. It's 240 units. Tons of reasons to
240 or 204?
204.
204?
Yeah. It's CM2 zoning in Portland. What I love about the deal is it takes advantage of Senate Bill 158, which was a Senate bill passed sometime last year, I believe. And it essentially allows a project like ours to exceed the height limitations, even with bonuses. So we're in CM2. You can go to 55 feet. With a bonus, you can go to 65. Then they passed the Senate bill that essentially if 75% of your building is residential housing, then you can ask for 10 adjustments to the zoning. One that you can't ask for is more FAR, but you can ask for height.
What's FAR?
Floor area ratio.
Okay.
So the gross size of the building still has to fall under code and what bonuses allow right now in code. But you can build higher. So it's a really cool asset because we bought it CM2 zoning. I would say quote unquote CM2 pricing, right? Because the yield from a zoning standpoint only gets you so far. And with this bonus, we're getting, I want to say, another 40 units out of the project.
Wow.
So it's substantial.
How big is the lot?
One of the sites is 30,000 square feet. Full site, and then there's a street, and then we bought the site next to it as well that's L-shaped. We'll go ahead and sell off the 5,000 square feet in the back to Mike, hopefully.
Your guy actually called me.
Did he?
He texted me. I was short with him. I have no fucking clue desire to do that.
Yeah. And that site is about like 20,000 square feet.
That seems small to me to put 204 units on based on the projects like we're doing because they're way different.
So on the 30,000 square foot lot, it's a 6-story building. We'll get 129 units out of that building, and then the one across the street will get 77.
So this is the tallest project you've done also?
Yes.
So you're bringing cranes in now to do all this?
Yeah, I mean, not like skyscraper cranes, but yeah, we'll have to have cranes on the project.
Just whittle cranes.
Yeah, because Mark's looked at a couple of those, and he's like, just looking at the budget, it just costs so much more when you start going that high.
Yeah, I mean, that's what's funny is the construction type is the same. We're doing a podium deck, wood frame above, but going that one extra floor does make a difference.
Yeah. So what'd you buy this lot for, and how'd you find it?
So pretty sweet. We bought it at $75 a foot. It appraised at $110 a foot. So we got a great deal on the land. Had it under contract, I want to say, for about a year. Closed on it just this last August.
And you're doing all your like due diligence during that period?
Yeah. So we'll be done with our land use the first week of December, and then we'll submit for building permit the last week of December if they're even open. But
good luck.
Yeah, it's 12/29 is our target date. We went over it yesterday, and I was like,
there will be someone in the office. There will be that one individual,
one person.
Yeah. So yeah,
that's funny.
And they're relatively at the peak, so it appraised at $110 a foot, but at the peak it was probably like close to $2.
Oh gosh, I would say you probably could get it up to $2. I mean, if it was, a lot projects this size, a lot of people don't sell them permit ready because the developer is so particular about what they want to do at a project of that scale. But if you sold it entitled, you could probably get 160, 170 for it.
No, I mean prior to the crash. So it's like the last big land sale was just south of 84 on 21st. That institutional investor paid like $220 a foot for that last corner block that they're developing now. Probably the sexiest building in Portland that's being developed now. they wouldn't have paid that much for your location, but you're only a few miles away. You're in the same asset class. So probably it would have been about $200 a foot, maybe a little less.
Yeah, I think that's fair.
So the appraisal was 60% of that, 55% of that, and then you bought it 10, 15% less than that.
Yes.
So this is the beauty about fucking land, is it drops like a freaking rock.
It's the first thing to go.
And if you're a developer and you can understand the tides versus the waves, that's when you can change your entire trajectory.
Tell us why land is so volatile in its pricing.
It only has one type of buyer, and that buyer only develops if market conditions are good.
Well, also, it's the only thing that the price just has to change.
Has to change.
Yeah.
Well, it's like you can't.
It's the only variable.
Wood costs what wood costs.
Mm-hmm. Yes.
Labor costs what labor costs. Land costs what land costs on that day. Like that's the only thing that can just flex.
Yeah.
Because it is a what do they call it? It's a finite resource.
Yeah.
And funny enough, infinite resources are actually the ones that have the fixed costs. And the finite resources can be really, really, really expensive, but they can also drop in value really quickly.
So when you get a rip like that, you're not getting a rip for providing cash. It sounds like you're entitling it and then closing on it. Does that then give you room for a higher developer fee? Like, how does that change your structure at all? Like,
Yeah, so it's hands down our best performing asset as far as what the projected yield on cost will be.
yeah.
So theoretically, yeah, you could increase your developer fee. You could, increase your budgets enough to make sure that they're healthy, and then do some sort of fee split with the investor, saying, "Hey, if we save $1 million, you guys get 500, we get 500." We're just treating this like any old deal, which is why the yield on cost is what it is. But yeah, theoretically, you could.
Mm-hmm.
We also look at this project like it certainly will be the first one that we do with an institutional group. And so being able to deliver for them is much more important than trying to squeeze every last dollar out of it.
Well, and it's your first project after a down cycle. That should be your best yield on cost.
Yeah.
Like, that's exactly how cycles work.
Yeah, exactly.
So does that give you further leverage too, because you already have created more equity within the land right off the purchase?
Yeah, so yes, theoretically. The way that I'm running the numbers on the land basis is what we bought it for, minus selling that 5,000 square foot lot for whatever we get rid of it for.
You want to sell or finance it?
Yeah,
Like $250,000, something like that.
$250,000. Well, because you bought all this for like 3.5 or something like that. Then?
Yeah, about 3.5.
Yeah.
Yeah, so our land basis, once you sell that piece out and you look at both of them, you're probably in it at like 2.19 for 129 units, which, to just give you numbers, our 55 unit lot, we bought that site for 2.2.
Yeah, we bought ours to put 66 on it for 175 or something like that. So yeah, that sounds great.
Yeah.
So how'd you find this deal?
It was off market. About to go onto the market. So that's one of the things we try and have great relationships with our brokers, and try and always put in their ear, hey, if you have something coming down the pipe, before you list it, we'd love to take a look at it. And that was one of those projects where, they had the OM or whatever put together and they sent it our way. And I loved the location. It was close to Salt and Straw and Little Big Burger and all these fun little restaurants. And so we made an offer on it before it hit the market.
How many deals do you have to look at to find one that works?
I would say since June, I've probably looked at 150 different sites in Portland.
Yeah. And a lot of them, are they like, if you got the land for free, it still doesn't even work?
Yeah.
Because that's what we kind of find.
Yeah, I would say there's generally a large discrepancy, between what an owner thinks it's worth versus what it is today. It's like, it's probably dropped 50% in value. And if that person is still willing to sell, great. But location, right? That's like the first sentence when you think about successful real estate. And so being able to balance being in a safe location that has, I always say we have building amenities. This one will have rooftop deck. It'll have a second floor deck, barbecues, all that fun stuff. But in Portland, we view the amenities as a neighborhood. So how close are you to your favorite restaurant? How close are you to your favorite activities? And so that's a huge focus for us. And then also being in a market that has some Class A assets around, knowing that we can go through that value creation model with the development process and then still charge just a hair less than that. that is a tricky balance to find.
Yeah. And what's your targeted yield on cost on something like this?
Average across our entire portfolio is 7.17.
Okay. And these are like 5 cap assets, so you're creating a nice spread on that. then.
Yeah. We have a minimum spread of 175 basis points. Again, a cap rate right now is really hard to nail down.
Yeah.
We're looking a lot at price per unit and making sure we have a healthy margin there.
Okay. So do you do all the design during that first year as well?
Yes.
And then you have everything dialed by that point.
Yeah, I mean that's I credit our construction team a lot. You know, we're very dialed in. I would say our DNA as a developer comes from the construction field, and you know, a nice benefit that we have is when we look at a project, we know within 1% what our budget's going to be by the time we hit buyout. I think this year we're pricing out like $90 million in construction, so we've got a very good grasp of data, and then that allows us to design much easier because we have a prototype. We know what finishes we want in the building.
So did you bring in a co-GP on the front end to purchase the land?
Yes.
And then have you found the back end money yet?
No, so a project like this will kind of go in phases as far as raising the larger check. First phase is kind of just flirting, right? Like, hey, in 6 months, we're going to have this thing. We're going to hit the ground running probably sometime in the middle of January. And that process will look like one of two things. We've got 13 groups right now that are interested in investing in the asset.
That's a good pool to start with.
It's a great pool to start with. But again, we'll get 13 proposals, and 10 of them will go right out the door. Then we'll have 3.
They're making you the proposals?
Yeah, so we'll provide them the deal financials.
It's like an RFI, a request for equity, RFE, request for equity.
Yeah, I mean, we tell them what we need. We send them the model, but we don't necessarily lead the horse to water. It's you guys tell us based on the financial model what you guys want on this project.
Interesting.
Yeah, and so it's kind of like what we just did with the debt markets. You know, we'll get proposals, and if there is measurable data that says that we can get better financing, then we will go ahead and continue to go down that path. And if we can't do it directly, which again, I feel confident in our Rolodex, then we'll bring on a brokerage to assist.
Okay. And what do you think you're going to build this project for all in and cost per square foot?
Yeah. So both projects together, it's about $50 million. What was your second question?
What's the cost per square foot on that?
Oh gosh, I don't know off the top of my head. I would say
What's the square footage on it?
One building's 120,000. The other one is 70,000. I'm going to say maybe 65,000.
All right, quick brain math, Dane.
250. Yeah.
Oh, you guys are pretty good at math.
264
per foot.
That's more accurate.
Yeah,
it's a little more accurate.
Yeah, what we like is our per unit cost. I mean, our per unit cost on the project is anywhere from $223 to like $240, and knowing that, you know, I was just telling Trevor a moment ago, it's like there's transactions now happening at negative leverage in Portland with national groups buying at $320 a door, and those assets don't have something that these assets have, which is the 10-year property tax abatement. So if these institutional buyers are buying these products at $320 a door, and their OPEX is 30%, and ours is 20%, that makes our asset that much more compelling when we deliver it because they can eat into that negative leverage because of the increased NOI.
So is your play, you think, going to be build and sell then?
Yeah, I mean, I like to make sure that they're financed on the front end to hold. And again, it's kind of like the Godfather offer. If we see that we're entering a period where there's offers we can't refuse, we'll exit the asset.
Yeah. And are people okay with that flexibility you find that invest with you?
Yeah, I mean, again, it's about marrying the capital to the deal. There are some deals that we know we're going to exit. We feel like in 24 months the market's going to be back to a place where selling assets is going to make a lot of sense. But then we've got assets that investors want to stay in for 5 years. They, however, know that, hey, there might be a possibility that we exit sooner, and there might be a possibility that we go ahead and roll into perm and hold it for 7 years. Yeah. And just trying to find that flexibility. And I would say with the larger check writers, they just want to know that there's a viable business plan. They're not necessarily looking to turn and burn their returns as fast as possible.
Yeah, that makes sense. How many exits have you done to date now?
0. We have not sold anything.
Okay, because you were selling one a while back. Did you ended up refinancing and holding that?
Yeah, so we ended up, it was a FDIC insured bank that had the loan on it. Construction loan originated at 6%. Can you guys imagine a 6% construction loan today? So it was originated at 6%, floated all the way up to 10%. negotiated with the bank to essentially say, hey, we're not going to make a payment at 10%. We need you to adjust the rate back down to 6%. We need 3 years. We need it to be IO. And so finalize that negotiation, and we've got it whole.
Was that a learning period of like not thinking rates would go up and they're spreading it, and then you're like just going in thinking rates will stay flat, and you've kind of learned from that?
Yeah, I think it was more of the speed in which rates went up, not so much that they would go up. I think we knew they would go up.
Yeah.
Trust me, we were sweating when we were like, oh my gosh, a 100 basis point hike, like what is going on?
Yeah, the first few months wasn't that bad.
No.
It was when they just started talking higher for longer and higher and higher, and then you're like, fuck.
Yeah, it went from, was it transitory? Is that what they used?
Yeah, it was because
what was the word?
That was inflation was transitory.
Well, sure, but they were offsetting it with these rate hikes.
Yeah.
It was like,
it's all transitory.
it was that March. They started in March. By July, you're like, okay, and then August, September, you're like, okay,
What is going on?
Yeah, that's where everything shifts. That's when you're like, okay, head down.
Yep.
No more acquisitions. Tidy everything up. Your loan proposals are significantly different than what you planned for at acquisition. And that's where you had a good question in the last episode. Is like, what are you doing in that 2.5 years when you're not building anything? And the beautiful thing is, like, as a capital raiser and as a developer, is you get to do two things that probably a lot of people aren't doing, which is one, communicating with your LPs. So you know that I'm still in the game.
Yep.
You haven't lost your money. No one's happy.
Yep.
Like, let's not fucking sugarcoat some shit.
Yep.
No one's happy, but we are still alive. We are operating. We're keeping our occupancy as high as we can while we're keeping, I have no clue what that is. While we're keeping our occupancy as high as it is, we're trying to find other assets.
Yep.
And then, like, when the hold versus sell model, a lot of your market cycles will have impressions on that. For example, is what you build now, when you're done with that project, you're going to be exiting at such amount of equity. You're going to have so much equity at that point where holding makes no sense.
Yes. Yeah.
You have to sell.
Yeah.
To liquidate that asset, put it into another project that won't get as much yield on cost, but you still create the value, and so it becomes a stacking game. And that's exactly what we saw in the last cycle in Portland.
Yeah. And I think, a huge benefit too is that there's, I'll say it again, there's so much liquidity in the market. So it's like that example of how we negotiated with our lender on that probably is not a viable strategy back in 2008.
Could you speak on that?
Yeah.
Because I think last episode you were in the middle of it, and then we removed that part because you're like, hey, never mind about
Still
that.
in the thick of it. No, yeah. I mean, it was a great learning experience. I would say we're very blessed to have really strong relationships with families in Portland that have owned institutional real estate. And a lot of it was, frankly, being taught how do you negotiate with a bank when you can't afford to pay what you owe the bank. And what we learned was, especially these FDIC insured banks, but also these private credit groups, is they don't want special assets, right? So if you're a publicly traded bank, you have to report how many of your loans aren't doing well, right? And so that was kind of a, wait a minute, like they don't want this to fail just as much as we don't want it to fail. How can we negotiate in a way that leads us to a place of reconciliation? And so a lot of it was just kind of playing hardball and, hey, we're not going to do this, we're not going to do this, and you just kind of slowly massage it into a place where it makes sense.
I was going to say, we met, and I was talking through that with you, and you said that you had met with like a relatively young guy in Portland whose family had owned real estate for a long time.
Yeah.
And that he just told you to tell them no.
Yeah. No, that was quite literally it.
Like, what?
Yeah, no, the gentleman's family who owns our office building, he's on the top floor. We're on floor 8. And we went up there and was chatting with him about it. And he was like, oh, yeah, we dealt with this in 2008. Essentially tell him, kick rocks. And I was like, no way. This is a $12 million loan. Like, I can't say that. And that kicked off a conversation of, okay, what does work for you guys? What can you afford? And, it wasn't like, playing poker. It was a lot of just being honest and saying, hey, this is going to work. This is not going to work. And again, what the big eye opener was realizing that a lot of these financial institutions, FDIC insured banks, not so much, but these private credit groups, you can structure them really any which way. And some of these groups are levered up on credit lines 10 times what their actual cash is, and they get in trouble pretty quickly.
Yeah, that's been our biggest learning experience recently, is like seeing that you can do that with banks on projects we're trying to buy, or like the experience Gabe went through. Like, you kind of had a similar thing where he took over a failed project and it had so much default interest, and it's like,
Waive
you
it out.
have to waive that
Yeah.
or like it doesn't work.
Yes. Yep.
And like they do not want these assets back because they can't finish it.
No.
And then they're in an even worse position.
Exactly.
So like that project we were looking at, we saw a bank. So they
Oh my goodness!
So a bank from New
Don't
York.
give too many details.
Yeah, well, a bank from New York underwrote this dude's project to a 3 cap on exit in a market where no property has ever traded at a 3 cap.
Not even close. Like a 3.25.
Sounds like
Give
some
them
great
little,
radio
little
shit.
leeway. Well,
Yeah.
because rates were like 2.75 at the time, so they were like, let's give them a 0.5 point spread from from interest to cap rate. And Trevor brings us this deal, and Trevor was like running all of our acquisitions for value add, but hadn't really. Sorry, I totally took this over because this blew my brains out. I was. Trevor was like learning on the development side, like as far as pricing for construction goes,
Yeah.
and like different markets, like what kind of construction it is, where it's at. Like it doesn't vary a ton, obviously, for 3-story walk up.
Yeah.
And so that's why we just came in, and Mark and he called us into the email, gave us the underwriting like an hour before, and Mark and I both looked at it, had never talked. We get on the call, we have like not very many details, and the bank's talking through it with us, and. I don't know how. I'll give specific. So they had $68 million lent out currently. The project was not finished. I won't give a unit count because that'll screw it all up. But
Yeah.
the project wasn't finished. There was going to be another 10 to 11 million that had to go into it to finish the project.
Wow.
In best case.
In best case, like best case, if this guy finished it. And Mark and I were both sitting there, and we were like, so like that's not anywhere near
not even
where
what
it's
it's worth.
like not even close
Yeah.
to what it's going to be worth. Like
Yeah.
there's no equity created, like,
Yeah.
but there's also equity like
Loss.
loan loss.
Yeah.
Yeah.
Like
And
30
he was
million
like,
of-
and he was like, yeah, we know. And we were like, so what are you at right now? And he was like, well, trying to be like coy about
Yeah,
it.
yeah.
And then we were like, you're probably at like 55? And he was like, we thought that might be a ballpark. And then he was like, what are you guys at? And Mark and I like both looked at each other because we hadn't talked about it yet. And I was like
30.
42. And Mark was like, I was at 41.
man.
we were both 36 million
Less than
below cost
Yeah.
on it. And so, because I mean, the cap rate on
Is
it
that a
now
local project?
it was in the state
Oregon?
of Oregon.
Okay.
Yeah.
Okay.
I mean, we were on the call to finish it, right? That's why they had talked to us
I
about
imagine
it.
you guys didn't move forward with that project.
Well, not yet.
Oh, okay. It
It just
yeah.
needs to ripen.
Yeah.
Well, like
it
I
just
don't know
needs
what
to-
something like I don't know what happens with something like that.
bank writes that
Right
off.
off. Yeah. Investors
The
lose their money.
And that's the guy that was on the call understood.
Yeah.
Like he was not confused about it. He
Yeah.
was the one who underwrote the deal on the front end.
Yeah.
And so he was just kind of he knows how to underwrite. He's underwriting $75
Does he?
million. That's the ticket, right?
Yeah.
I mean, he's not private credit.
Sure.
Right.
Sure.
And so he's not underwriting for a group of investors that are
Let's reframe that. He knows how to put an Excel sheet together.
Correct.
That may or may not make sense.
underwriting.
There you
That doesn't mean he knows how to perform on a project, but I mean, he's not the
But
one.
he can actually read it and say, okay, this is worth
He was
30 million
told.
less.
He was told, hey, here's our margins right now, and he underwrote to that. Like you can't fault that guy. And then he
Yeah.
gets on the call, and it's just like, okay, I know what I would really like to get out of it, and we're like, okay, well, but if we're gonna
But if
finish
he's
the project and then
non-recourse-
make money,
Yeah.
like
he doesn't. That's where I don't understand is the people that own it. They should just get out of the way. Like the one that we were looking at, it's like, dude, you have no equity. You trying to get any equity out of this is just making it worse. It's pissing off your agent. It's pissing off your buyers. Just admit that you have no fucking equity and go do a short sell and just
Yeah.
let the deal get done.
Yeah.
Let the bank move forward. Sorry.
No, I 100%. I mean, I agree 100% because it's like nothing's worse than throwing good money at bad projects.
Right.
Yeah.
And it's like, it's already bad.
And
Just
there's so
cut the
many
fat.
people that feel like this isn't a bad project and someone's going to throw money at
Yeah.
it. And you're like, that is not reality.
to the credit of, or not to the credit, but to give like more explanation on that project, that guy is historically very, very good at what he does.
Well, so was the guy that did the Ritz.
Yeah, yeah. The guy that was a little out of his wheelhouse.
Dude.
This guy does tons of these projects
too soon?
and still holds tons of those projects. And he knows that although he is in a bad position on this project, that he's also one of, if not the most qualified person
To do it.
to keep the project.
Yeah.
And so he's slow rolling it. There's no reason for him to, it's like, oh, you want this other group to, well, you've seen me perform on, because the bank's lent to him on 10 other deals, 20 other deals, right? Or that.
So is he going to back his way into it through a partnership?
Oh, yeah. He's probably going to buy himself out of his own project and then still own it in the end.
Just get 30 mil off his
at
note.
some huge
Well, there was
discount.
that developer in San Francisco that just did that, where he bought it, did it, defaulted, bank took it
and
over,
bought it
and then
from
he
the bank.
bought it back at like 40% discount.
Yeah.
It was genius.
Non-recourse debt.
I mean, that's like when you're Jamie Dimon, and only one person in the world can do your job.
Yeah. Yep.
You have all the leverage in the world.
So for a guy like that, when he actually goes through foreclosure, how does he bring on new debt? Because that hurts his borrowing power.
Yeah. So it depends. I would say foreclosure, in my opinion, means that there is not an amicable path for both parties to get out of the project, right? It's like you typically, what we've seen is like deeds in lieu and that sort of thing. I mean, if it goes through foreclosure, that is, that's probably a developer that really believes in the project.
Just not giving the keys back.
Exactly.
I mean, what is like that has to be somebody that's at the end of the life cycle, like has of their life cycle of doing projects, right? I feel like nobody that's in the middle of
Even at that
like,
point,
doing
you
well.
give the keys back and then you sleep better.
Well, I agree that you should, but I'm saying like that's somebody who's like clearly in their mind is done, and they're just trying to hold on to whatever they have left.
I don't even think in their mind they're done. They're mentally ill in their mind and so far out of reality that they can't just make a logical decision.
Yeah.
They're so far brain fatigued that you just can't make a quality decision.
You want something to happen that you know won't happen,
Right.
but you're just kind of closing your eyes and putting your head in the sand.
Yep.
Yeah.
I think that conversation is different too when you talk about FDIC insured banks versus the private credit world. If it's private credit, you've got a list of investors you got to share some bad news with. If you're FDIC, in my situation, it was an FDIC insured bank. And there's a whole list of regulations that come along with them having something go into special assets where they have to maintain a different level of reserves. It totally screws up the way they operate. To them, to make some concessions and work with you to get off of that loan is a lot different because it's hindering their ability to go forward and do new loans. Even if they would rather take the loss and have it off their books so that they don't have to have all of those other special list of circumstances weighing them down.
Regulators come in and say, hey, you guys made a shitty loan.
Yeah,
we're going to tighten up what you guys can do.
Yeah.
Exactly.
And as long as you're doing that at a very, very low percentage, then you're just writing that off of your income.
Yeah.
Like it's not even the end of the, obviously it's not best case scenario, but
what's
it's like,
interesting
you'd
too
rather
is
just
like-
write it off and not have to deal with all the regulation on that side.
That scenario is exactly why we're not seeing those distressed deals everyone thought would happen. Is like the bank is still willing to play ball.
The workouts.
Yes.
And it's almost like the deals that you're seeing now are just the sellers that have seller fatigue. And they're like, all right, hands up. I'm just not going to wait for this market anymore.
Yeah.
It's not going to get better. I'm not going to wait it out. I'm just going to sell.
Yeah.
How many projects in Portland end up like that you see?
I've seen two larger multifamily projects that were financially distressed because of leverage that have been purchased by other developers that are like, yeah, I'll buy it at $150 a door. I've only seen two of those. One of them was a gorgeous building, kind of funky unit layout, 6-story building. I would say it was about 90 units. And then the other one in a not so great area of Portland, off the Max line, had those types of headaches, no AC. But yeah, not a lot. I mean, frankly, I know a colleague up in Portland that set up an entire fund to buy these distressed deals. And I talked to him probably 2 weeks ago. I'm like, gosh, how much capital have you deployed? You raised $10 million. What are you in? He's like, I'm in one 15-unit deal.
Oh.
That's all I can find.
And he pre-raised all the money
Has
for it?
all the capital. And he's been doing this now for probably a little under 2 years.
So what does a guy like that do? You just return the capital eventually with no
Return
profit?
the capital and or amend what the fund's purpose is. So again, that's what a lot of these large groups are doing, is going back to all the investors that they raise money from and say, hey, we were going to do this, but now we're going to do this.
Yeah, there's a ton of that out there. The former exec guy from True America raised a $4 billion fund to go, and this is just recent, to go out and buy distressed assets. But there have been funds like this popping up over the last 2-3 years.
Yeah.
And I just don't think they've been able to deploy the capital that they thought they'd be able to.
Yeah, and again, it comes down to the liquidity from today back to 2008. There's so much more. Banks will get creative, kicking the can down the road. It's just, we're not in the world where, gosh, there's 10,000 foreclosure hearings happening in Multnomah County.
Yeah. That's like you kept mentioning, there's so much more liquidity. And if you go back to 2008, they had it on both sides. Residential was fucked. Commercial was fucked. And they hadn't come out of a huge printing cycle. We hadn't even started a printing cycle. And so that is what gives the banks time and gives them flexibility, is the structure of everything.
Well,
what's
and
interesting.
Sorry.
No, I was going to say what's interesting about that time too is residential and commercial were fucked, as Mike would say. But there were
Mike's word.
There were only single-digit foreclosures in Portland for apartments during that period of time.
That's what I was going to clarify.
Right? So it's like kind of the same ethos of like, oh, we'll kick the can down the road, except for we have way more capital in the market now than we did back then.
We have way more capital, and the problem then was the residential side, not the commercial side. And right now, the residential side is fine because everybody has 30-year mortgages at 2.75%.
And they get to live in their debt.
Yeah, they're fine. Yeah. They have 30 years to figure out a way to get out of it. And by that, I mean they're just going to pay it off because their mortgage is $2,000.
Well, we also reverse. So for the first time since COVID, there's actually more homeowners now that have a 5% interest rate than a 3% interest rate.
Wow.
So like that mortgage, what they call it, the mortgage lockdown effect, is naturally dissipating.
Yeah, it has to. Because most people who own homes don't want to rent their homes out, even though they should rent their homes out if they.
No, they should not. We cannot be who we are if everyone rents out their homes.
I know. I'm not. Hey. Here's the funny thing about that: you can tell everybody exactly what they should do, and most of them still won't do it.
That makes you feel even smarter.
No, it doesn't. That's just you can't. I shouldn't. I'm not going to lie about what I think they should do, though.
Is that how Trevor
I'm going to be
feels
honest
with all of you
them.
guys?
True.
Trevor gets so fired up.
doing it.
Tells us exactly why is it not getting done. Keeps him up at night.
Well, I know you had to go, and we want to respect your time.
Yeah, 9 minminutes ago.
What a nice surprise.
My guy.
Yeah, they said, what time does Hamilton show up? I'm like, who the fuck is Hamilton?
You guys, like, you've met Michael multiple times.
Is this a play? Are we watching a Broadway show today?
Oh, God, the amount of times I've heard that.
I bet.
Oh, my God.
Sweet, dude. Well, we appreciate you coming on. Do you guys want to talk about Michael once he leaves?
No,
Yeah.
we'll talk off the air about him.
Oh, God.
How much we love him and appreciate him. Michael, you're doing great things. Seneca Development, if people want to reach out to invest with you or to bring you a deal, how do they reach you?
Info at SenecaDevco.com.
And Seneca, Seneca.
You got it.
All right. Thanks again for joining us on this episode of Deal Junkies. Deal Junkies, we love you. We hope you're enjoying this podcast. Please share us with one person per day. That's all he wants you to do is share it with one person you think might get some value out of listening to Michael Hamilton today talk to us about development in Portland.
Yes, sir.
Thanks again for joining us. Deal Junkies, we'll see you next time.